This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Kratos Defense and Security Solutions, ticker KTOS, is not a household name. But inside the corridors of the Pentagon, inside classified programs, and inside the fastest-growing corner of modern warfare, this company is building something that demands attention. The question driving everything in this video is simple. Is Kratos actually capturing its market? And is the stock pricing that correctly? Over the next few minutes, we will break down the business and the opportunity, track a revenue growth story that is genuinely accelerating, interrogate the competitive position, stress test the unit economics, and put the valuation under a hard light. 23% revenue growth does not happen by accident. Whether it is sustainable, whether the market has fairly priced it, and whether the risk-reward still makes sense for investors, that is exactly what we are here to find out. The data is in. Let the analysis begin. The aerospace and defense sector is not a cyclical trade. It is a structural one. Geopolitical fragmentation, the rise of autonomous warfare, accelerating modernization of legacy military platforms, and sustained governmental commitment to national security spending have created a demand environment that is both deep and durable. For a company like Kratos, positioned squarely at the intersection of unmanned systems and advanced defense electronics, those tailwinds are not abstract. They show up in the revenue line. Looking at the trailing 4 quarters, Kratos generated $351.5 million in the second quarter of 2025, $347.6 million in the third, $345.1 million in the fourth, and then accelerated to $371 million in the first quarter of 2026. That uptick in the most recent quarter is a signal worth watching. The stock currently sits at $55.25, well above its 52-week low of $42.81, but meaningfully below its 52-week high of $134. That positioning tells a story of sentiment recovery, not euphoria. With 4,000 employees generating $336,700 in revenue per person, Kratos is operating at a respectable output per head ratio for a defense contractor of its scale. The real question is whether the company can push that number higher as contract wins compound, and whether the top line has room to run significantly from here. The flywheel is spinning faster. That is not a metaphor. It is what the quarterly numbers are showing. Kratos' revenue growth is not just continuing, it is accelerating, and that is one of the rarest and most powerful signals a growth investor can find. Go back to the second quarter of 2022. Year-over-year growth was 9.3%. By the third quarter of 2022, it reached 14%. Fourth quarter of 2022, 17.8%. The trajectory kept building. By the third quarter of 2023, growth hit 20.1%. Then there was a brief soft patch, just 0.5% growth in the third quarter of 2024 and 3.4% in the fourth. But then the re-acceleration arrived with conviction. First quarter of 2025, 9.2%. Second quarter, 17.1%. Third quarter, 26%. Fourth quarter of 2025, 21.9%. And the most recent quarter, first quarter of 2026, posted 22.6% year-over-year growth, with revenue reaching $371 million. That is not a company drifting forward on momentum. That is a company where demand for its platforms, unmanned aerial systems, satellite communications, turbine technologies, is compounding. The growth engine is not plateauing. The question is how far this acceleration can carry. When you cannot benchmark a company against peers, you turn to the fundamentals themselves. And what the scorecard reveals about Kratos is a business with genuine strategic depth, but real financial tensions that need to be weighed honestly. Start with gross margin at 22.1%. For a defense contractor delivering complex autonomous systems and advanced microwave electronics, that margin reflects the capital-intensive, program-driven nature of the business. The concern is direction. Margins have been compressing, down 5.6 percentage points over the past 5 years. That is not a trivial move. It raises a legitimate question about whether Kratos is winning contracts at the expense of pricing discipline or absorbing cost pressures it cannot yet pass through. The Rule of 40 score stands at 8. The benchmark for a healthy growth business is 40. the combined sum of revenue growth and profitability margin. At 8, Kratos is well below that threshold, meaning the growth rate is not yet being matched by a commensurate improvement in the profitability of the underlying business model. Free cash flow is negative. The company is burning cash, which in the context of long-cycle defense contracts is not unusual, but it does place a premium on execution. Turn to the revenue momentum chart and the picture sharpens. 8 consecutive quarters of rising revenue, with year-over-year growth rates climbing sharply in the most recent periods. Demand for Kratos platforms is clearly real and durable. The verdict? The Moat is built on program depth and classified relationships, not yet on margin expansion. That makes execution the defining variable. The gross margin trend is where the unit economics conversation has to start. And it asks a hard question. In 2021, Kratos carried a gross margin of 27.7%. By 2022, it had slipped to 25.2%. 2023 saw a partial recovery to 25.9%. Then 2024 compressed again to 25.3%, and 2025 landed at 22.1%. The 5-year direction is unambiguously downward, 5.6 percentage points of margin erosion over that period. A contracting gross margin combined with a Rule of 40 score of just 8 tells you the business model is not yet operating at the efficiency level that its growth rate alone might imply. The Rule of 40 benchmark exists precisely to capture this tension. Growth alone is not enough if the underlying economics are weakening. At 8, the combined score signals that profitability improvement needs to keep pace with revenue expansion. On the operational leverage side, 4,000 employees generating $336,700 in revenue per person is a meaningful data point. If Kratos can grow revenue faster than it adds headcount, which the recent acceleration suggests is possible, that revenue per employee figure becomes a leading indicator of improving efficiency. Taken together, these numbers surface a critical question heading into the valuation discussion. With a current price-to-sales ratio of 9.9 times and an enterprise value to revenue of 124.9 times, is the market paying a multiple that the current economics can ultimately justify? The PS ratio history panel tells a story of dramatic multiple expansion. At the end of 2021, Kratos traded at 3 times sales. By the close of 2022, that had compressed to 1.5 times. It rebuilt to 2.6 times by end of 2023, then 3.5 times at the close of 2024. And by the end of 2025, the multiple had surged to 9.9 times sales. The market has re-rated this company aggressively, and the question is whether the fundamentals justify that re-rating. The valuation meter answers part of that question. The PS to growth ratio sits at 0.44 times. In plain English, that means the market is paying less than $0.50 of price-to-sales multiple for every percentage point of annual revenue growth. A ratio below 1 times is conventionally read as the stock being cheap relative to the growth it is delivering. At 0.44, the signal leans toward undervalued relative to growth pace, even at today's elevated multiple. The revenue growth trend chart supports that reading. Year-over-year growth has been climbing, recently crossing 22%. That trajectory gives the current 9.9 times PS some fundamental grounding. The gross margin trend, however, introduces a counterweight. Margins have compressed from 27.7% in 2021 to 22.1% in 2025. A contracting margin profile typically argues against multiple expansion. The Rule of 40, score of 8 reinforces that caution. Combined growth and profitability remain well below the 40-point standard. On Analyst scenarios for 2027, the bull case implies a PS of roughly 11.9 times if growth accelerates and the story exceeds expectations. The base case holds the multiple near 9.9 times as current momentum continues. The bear case, at 6.9 times, reflects a world where growth decelerates or macro conditions tighten. Execution remains the deciding variable. 4 risks and 4 catalysts define the risk-reward framework for Kratos shareholders today. On the risk side, cash burn is real and ongoing. At $11.45 million per month, the company has approximately 37 quarters of runway. Manageable, but not unlimited. Any program delay or revenue shortfall tightens that equation fast. Multiple compression is a persistent threat for any stock trading near 10 times sales. A shift in interest rate expectations or a broader defense sector sell-off could reprice the stock sharply, independent of operating performance. Margin erosion is a structural concern. 5 years of compressing gross margins signal that cost pressures or contract pricing dynamics could continue undermining profitability even as the top line grows. And competitive disruption is a genuine long-term variable. The unmanned systems space is attracting well-funded entrants, including large primes with deeper balance sheets, and classified program competition can shift without public warning. On the catalyst side, contract acceleration in the unmanned aerial systems market, particularly as the Department of Defense expands autonomous platform procurement, could drive a step change in revenue. International expansion, given Kratos' growing relationships with allied governments, represents an underpenetrated revenue stream. Margin recovery, even a modest reversal of the 5-year compression trend, would dramatically improve the Rule of 40 score and justify a higher multiple. And any announcement of a major classified program win could serve as a powerful re-rating event. The verdict on Kratos Defense and Security Solutions is this: growth buy. The bull case is straightforward. Revenue growth is genuinely accelerating. The PS to growth ratio of 0.44 times suggests the market is not yet fully pricing the trajectory, and the structural demand for autonomous defense platforms is a multi-decade secular tailwind. If execution holds and margins stabilize, the re-rating has further to run. The bear case is equally honest. Gross margins have compressed for 5 years. The Rule of 40 score of 8 is well below the efficiency benchmark, and a stock that has already moved from 1.5 times to 9.9 times sales carries real compression risk if sentiment turns. But when acceleration is real, when the addressable mission is expanding, and when the growth-adjusted multiple still signals relative value, the weight of evidence favors being invested, not watching from the sidelines. The market is pricing Kratos as a growth story. The data says the growth story is real. The question every investor must answer now is how much execution risk they can hold, because that is what separates the bull case from the bear. Do the work. Size it accordingly.